Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about a stock that was suggested by a subscriber. That stock is Alibaba. Alibaba is a Chinese multinational technology company specializing in e-commerce, retail, internet, and technology. Today we will be reviewing the company's annual filing with the SEC to get a better idea of its core business segments. We will be reviewing the company's fundamentals by focusing on its key ratios. Then we'll look at the company's discounted free cash flow DCF analysis to find the intrinsic value of the company. And finally, do an expected rate of return calculation to see if you were to invest in Alibaba at the current stock price, what kind of return can we expect on this investment? So let's dive in and review Alibaba. Hey guys, let's start off by looking at the Form 20F, which is the annual report that Alibaba filed with the SEC. On page 83 of the report, the company provides a business overview. Alibaba states that it provides the technology infrastructure and marketing reach to help merchants, brands, and other businesses to leverage the power of new technology to engage with its users and customers and operate in a more efficient way. Alibaba claims that a digital economy has developed around its platforms and businesses that consist of consumers, merchants, brands, retailers, third-party service providers, strategic alliance partners, and other businesses. Additionally, Alibaba's digital economy generated about $1 trillion in gross merchandise value in the 12 months ending March 31st, 2020. Next, on page 142 of this report, Alibaba goes over its four operating segments. It states that it organizes and reports its business in four operating segments. The first is its core commerce segment, second is its cloud computing segment, third is its digital media and entertainment segment, and fourth is its innovation initiatives and other segment. On the next page, Alibaba goes over each of these operating segments. The core commerce segment is comprised of platforms operating in retail and wholesale commerce in China. The cloud computing segment is comprised of Alibaba Cloud, which offers a complete suite of cloud services to customers worldwide. The digital media and entertainment segment leverages its deep data insights to serve the broader interest of consumers. And lastly, its innovation initiatives and other segment includes businesses such as Amap, DingTalk, Tmall Genie, and others. After that, Alibaba breaks down its revenue across its operating segments. We can see that for the fiscal year 2020, the core commerce segment brought in majority of the company's consolidated revenue. When we focus on income from operations, we can see that the core commerce segment is the only profitable segment across all four operating segments. After that, the company breaks down its revenue across the past 3 years. We can see that for the year 2020, under the core commerce segment, specifically the China commerce retail, brought in about 65% of the company's total revenue. Overall, for the year 2020, the total core commerce comprised of about 86% of the company's total revenue. The cloud computing segment comprised of about 8% of the company's revenue. Digital media and entertainment comprised of about 5%. And the innovation initiatives and others comprised of about 1% of the company's total 2020 revenue. Lastly, I want to glance through Alibaba's mission statement. Alibaba believes that concentrating on its customer needs and solving their problems, whether those customers are consumers, merchants, or enterprises, ultimately will lead to the best outcomes for its business. Now that we have a good idea of Alibaba's business model, its four key operating segments, and its revenue breakdown, let's review the company's fundamentals by focusing on its key ratios. Hey guys, now let's look at the key ratios. I'm on Morningstar looking at Alibaba. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company made from its sales. All the numbers here are going to be in Chinese yuan. Back in 2011, Alibaba brought in about 6.4 billion yuan. And for the year 2020, it brought in about 510 billion yuan. When we look at the past 10-year trend, we can see that Alibaba's revenue increased every year for the past 10 years. Next, looking at the operating income. The operating income is the amount of money that's left with the company once the company has paid for its cost of goods and operating expenses. Back in 2011, Alibaba's operating income was about 1.7 billion yuan, and for the year 2020, it was about 93 billion yuan. When we look at the past 10-year trend, we can see that there were only 2 years when Alibaba's operating income did not increase from the previous year, specifically year 2015 and 2019. Other than those 2 years, we can see that Alibaba's operating income has been increasing every year for the past 10 years. Next, looking at the operating margin. The operating margin is the ratio of the company's operating income to its revenue. Back in 2011, the company's operating margin was about 26%. For the year 2020, it was about 18%. Ideally, we want the company's operating margin to be staying steady or increasing. However, for Alibaba, over the past few years, the operating margin has been decreasing. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2011, Alibaba's net income was about 1.7 billion yuan, and for the year 2020, it was about 149 billion yuan. Over the past 10 years, Alibaba's net income has been trending upwards. Next, we can see that Alibaba does not pay out any dividends, and this is fairly common for a growth company. Even Amazon does not pay out any dividends. And the thought process behind this action of not paying out dividends is that the company and the management believes that it is more profitable for the company to reinvest the cash that it has available in its core business rather than departing from that cash and giving it to its shareholders in the form of dividends. After that, looking at the shares outstanding, back in 2011, Alibaba had about 5,079 million shares outstanding. Its share count dropped down to about 2,332 million shares in 2012, and ever since then, the share count has been slowly increasing. For the trailing 12 months, the company's shares outstanding is at 2,742 million shares. Ideally, we want to see the company's shares outstanding number to be decreasing, as that means that the company has been buying back its shares, which helps increase the existing shareholders' ownership within the company. However, when we see a company that issues more shares, we can see that the share outstanding number increases, and this process of issuing more shares actually decreases the existing shareholders' ownership within the company. After that, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2015, Alibaba's book value was about $8.85 per share, and for the trailing 12 months, it's about $53 per share. Over the past few years, the company's book value per share has been increasing, which tells us that the proportion of the company's total assets to its total liabilities has been increasing. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2011, Alibaba's free cash flow was about 2 billion yuan, and for the year 2020, it was about 135 billion yuan. I will be using the past 10 years of free cash flows for my expected rate of return calculation, and I will be using the 2020 figure of 135,221 million yuan for my discounted free cash flow DCF analysis. Over the past 10 years, Alibaba's free cash flow has always been positive. In fact, its free cash flow has been increasing every year for the past 10 years, and that is certainly something we want to see in a company. Next, look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2011, Alibaba's net margin was about 26.69%, and for the year 2020, it's about 29.28%. What this means is every $100 that Alibaba made in the year 2020, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had about $29.28 left as pure profit. Ideally, we want the company's net margin to be staying steady or increasing, and we can see that Alibaba's net margin for the most part has been consistent and staying stable. Next, looking at the return on equity. The return on equity is the ratio of the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities who have a return on equity of 8% or greater every year for the past 10 years. Back in 2011, Alibaba's return on equity was about 26%, and for the year 2020, it was about 24%. Alibaba's return on equity every year for the past 10 years has been greater than 8%. In fact, for the majority of the past few years, the company's return on equity has been greater than 15%, and this means that the company has a moat. In other words, Alibaba has a competitive advantage over its competitors. Next, looking at the return on invested capital. The return on invested capital gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2011, Alibaba's return on invested capital was about 23.54%, and for the year 2020, it's about 11.72%. Alibaba's weighted average cost of capital, also known as the company's hurdle rate, is about 6.3%, and since the return on invested capital is greater than that 6.3%, we can safely say that management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. It gives us an idea of how many times can the company pay off its interest obligations using its income in that calendar year. Benjamin Graham, the father of value investing, preferred to only invest in securities who had an interest coverage of 5 times or greater. Back in 2011, Alibaba's interest coverage was about 82 times, and for the year 2020, it's about 33 times. What this means is Alibaba can pay off its interest obligations 33 times using its 2020 income. Now let's look at the company's financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to invest in companies that have a current ratio of greater than 1.5. Back in 2011, the company's current ratio was about 1.9, and for the latest quarter, it's at 1.67. Next is the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. Ideally, we want the company's quick ratio to be greater than 1. A ratio greater than 1 tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2011, the company's current ratio was about 1.75, and for the latest quarter, it's at 1.29. The company's quick ratio every year for the past 10 years was greater than 1.0. Next, looking at the financial leverage. The financial leverage is a ratio of the company's total assets to its shareholders' equity. A higher financial leverage number tells us that more of the company's assets are financed through its liabilities. Back in 2011, the company's financial leverage was at 2.06, and for the latest quarter, it's at 1.75. We can see that over the past few years, the company's financial leverage has been fairly stable. Finally, looking at the debt-to-equity ratio. The debt-to-equity ratio gives us an idea of the company's total debt to its shareholders' equity. Ideally, we want to see the company's debt-to-equity ratio to be less than 0.5. Back in 2014, the company's debt-to-equity ratio was at 1.05, and for the latest quarter, it's at 0.11. All these financial health and liquidity ratios are not only good from an absolute value standpoint, but in fact, they're better than competitors such as Amazon. Now let's look at the efficiency ratios. The first item on the list is the days sales outstanding. This number gives us an idea of how many days go by from the day company recognizes the sale to the day it actually receives cash for that service rendered. Back in 2011, Alibaba's days sales outstanding was at 2.83 days, and for the year 2020, it's at 12.02 days. Ideally, we want the company's days sales outstanding number to be staying steady or decreasing. However, an increasing days sales outstanding number tells us that the company may be aggressive with its accounting, and it may be recognizing its revenue sooner so that it can inflate its income numbers on its income statement. Next is the payables period. The payables period tells us how many days does the company take to pay its suppliers. Back in 2011, the company's payables period was at 4.69 days, and for the year 2020, it's at 80.02 days. Ideally, we want the company's payables period to be staying steady or decreasing. An increasing payables period tells us that the company may be holding on to its cash in order to artificially inflate its cash flow numbers. Finally, looking at the inventory turnover number, this number gives us an idea of how many times does Alibaba's inventory go through its system in a calendar year. Back in 2018, its inventory turnover was about 23.6 times, and for the year 2020, it's about 24.14 times. What this means is Alibaba went through its inventory 24.14 times in the year 2020. Over the past couple of years, the company's days inventory has stayed fairly consistent. Now let's compare Alibaba's current valuation to that of the S&P 500. The first item on the list is the price to earnings ratio. Alibaba's price to earnings is at 26.6, whereas S&P 500 is at 28.9. Alibaba's price to book is at 4.4, whereas S&P 500 is at 4.1. Alibaba's price to sales is at 6.5, whereas S&P 500 is at 3.0. Alibaba's price to cash flow is at 20.0, whereas S&P 500 is at 17.1. The dividend yield, Alibaba does not have a dividend yield because it does not pay out a dividend, whereas S&P 500 has a dividend yield of 1.6%. Moreover, when we compare Alibaba's 5-year average to that of its current valuation, we can see that Alibaba is currently trading at a discount to its 5-year average. And finally, when comparing Alibaba to the S&P 500, we can see that Alibaba is overvalued on all the valuation metrics other than the price to earnings ratio. Hey guys, now let's look at the discounted free cash flow DCF analysis for Alibaba. Over here, I pasted the 2020 free cash flow number that I got from Morningstar. The number actually was 135,221 Chinese yuan. The current conversion rate is 1 Chinese yuan being equal to 0.15 US dollars. So after going through the conversion rate, the free cash flow comes out to about $20,283 million. I'm using an annual growth rate of free cash flow to be 10%. What this means is I expect Alibaba's free cash flow to grow at 10% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate of 5%. What this means is after the 10-year mark into perpetuity, I expect Alibaba's free cash flow to grow at 5%. The company has 2,742 million shares outstanding and has a long-term debt of $18,041 million. I got this number from Alibaba's balance sheet. After taking all of these inputs into account, we get the intrinsic value per share to be about $223 per share. When we compare this to the current stock price, we can see that the current stock is trading about 6.4% above the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $203 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $629 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $223 per share. Now, if you disregard the perpetuity component, in other words, if you think that Alibaba is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $67 per share. If we disregard both the debt and the perpetuity, then we get the intrinsic value without the debt and perpetuity to be about $74 per share. Finally, since we know that the company's weighted average cost of capital is about 6%, and if we add a 3% margin of safety on top of that and make our discount rate to be 9%, then we get the intrinsic value to be about $286 per share. And in this case, the current stock price is about 18% below the company's intrinsic value. If we drop the discount rate even further to 8%, then we get the intrinsic value to be about $392 per share. And in this case, the company's current stock price is about 40% below the company's intrinsic value. Hey guys, now let's look at the expected rate of return calculation for Alibaba. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. The numbers that we had on Morningstar were in Chinese yuan, so I had to convert those numbers to US dollars, and I did that by multiplying those numbers by 0.15, as that is the conversion rate. And the numbers that we see here right now that are highlighted are in millions of US dollars. This is the yearly free cash flow trend that we get over the years. We can see that Alibaba's free cash flow has been trending upwards. Next, looking at the future data and predictions, I'm assuming that there's a 35% likelihood that Alibaba's free cash flow will grow at 10%. There's a 50% likelihood that its free cash flow will grow at 8%, and a 15% likelihood that its free cash flow will grow at 3%. These are the potential free cash flow rates that we get into the future. After taking into account the numbers of shares outstanding, which is 2,742 million shares, at the current stock price of about $237 per share, we can expect to get a return of about 3.7%. What this means is if we were to purchase a share of Alibaba at the current stock price of about $237 per share and hold the security through 2060, then we can expect to get an annual return of about 3.7% on this investment. Hey guys, now let's wrap it all up. We reviewed Alibaba's annual filing with the SEC, where we got a better understanding of the company's core business. We saw how Alibaba has 4 operating segments and only has one operating segment which is profitable, which is its core commerce segment. And even within its core commerce segment, more than 60% of its commerce revenue comes from within China. In other words, Alibaba has a big exposure to Chinese market. Alibaba's revenue, operating income, as well as net income over the past 10 years has been trending upwards. Alibaba does not pay out any dividends since, as a growth company, it believes that it is better allocating its capital by reinvesting in its business rather than departing from that cash and paying to its shareholders. Alibaba's return on equity has been greater than 8% every year for the past 10 years, which meets one of Warren Buffett's investment criteria. In fact, Alibaba's return on equity has been greater than 15%, which tells us that the company has a moat. In other words, it has a competitive advantage. Alibaba's return on invested capital is greater than its weighted average cost of capital, which tells us that the company's management is creating value for its shareholders. Alibaba's interest coverage has been greater than 5 times, and its current ratio and quick ratio both indicate that the company has more than enough current assets to fulfill its current liabilities. The company's financial leverage has been consistent over the past few years, and its debt-to-equity ratio has been decreasing, which is a good sign. Alibaba's current ratio, quick ratio, financial leverage, and debt-to-equity ratio is better than its competitors such as Amazon. When we compared Alibaba to the S&P 500, which is the aggregate of the top 500 companies in the United States, we saw that Alibaba, on all the valuation metrics other than the price-to-earnings ratio, was overvalued to the S&P 500. When we performed the discounted free cash flow DCF analysis, we found that when we use a 10% discount rate, the intrinsic value came out to about $223 per share. And when we use a 9% discount rate, the intrinsic value came out to about $286 per share. And when we compare that $286 per share to the current stock price, we can see that the current stock price is trading about 18% below the company's intrinsic value. Next, when we performed the expected rate of return calculation, we found out that if we were to purchase a share of Alibaba at the current stock price of about $237 per share, then we can expect to get an annual return of about 3.7% on this investment. Overall, Alibaba is a fundamentally strong company. Similar to Amazon, Alibaba prioritizes customers over its employees and shareholders. In fact, the priority that Alibaba has is first are its customers, then its employees, and finally its shareholders. And Amazon is a living proof of the returns that when a company focuses on its customers, in the long run, the shareholders will benefit. Additionally, Charlie Munger, who is a famous value investor, recently took a stake in Alibaba. In conclusion, Alibaba appears to be an undervalued security. It has a margin of safety and provides an exposure to the Chinese economy. Hey guys, that is all I had for you this week. Hopefully you found this video on Alibaba interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I will greatly appreciate it. Thank you.